Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Russ Koesterich of BlackRock saying this: we think markets are vulnerable to modest pullbacks on both sticky inflation as well as the pre-election trade as we get into late summer and fall election season. That said, we think the market can end this year higher. Russ joins us now for more. So Russ, let's start with the equity market picture, sir. You've been trimming since spring. I know you're still constructive on the stock market. Can you just walk us through where you've been pulling back just a little bit?
Absolutely. Good morning, Jonathan. Look, we still think the market's going to end the year higher. We're still in a bull market. That said, we've taken a little bit off the table. We started doing that back in the spring. And I think it reflects a few things. One, the magnitude of the gains, the fact that you still have a lot of uncertainty around the Fed. And the sentiment is going to get a little bit more challenging as we get towards the end of summer and the early fall, and the market deals with the uncertainty of a very unusual election.
What about the election, Russ, are you concerned about? Because what we hear from a lot of people is that it's the bond market, not equities, and that's where the risk is. Is that how you and the team see things?
I think the biggest issue is really simply the uncertainty that hopefully will be resolved once the election is over. In terms of whether or not you're going to get aggressively long or short the market, it's generally been the wrong call. I think what you go back to are the fundamentals: strong growth, inflation is moderating, albeit not in a straight line. But the reality is investors are likely to deal with some of the uncertainty in the run-up, and that often causes a little volatility in September and October.
Russ, it strikes me that we're talking about the equity market as a monolith and taking risk exposure as though all of it were exposed to macro risk or any risk whatsoever. How much do you just basically hide out in certain cash-rich companies, the magnificent 2 or 3 or whatever is left, and basically stay away from small caps, stay away from those that are interest rate sensitive, stay away from those that are vulnerable to all these risks?
So, look, this is a great question. And I do think that the mega cap trend, again, not necessarily just 2 or 3 companies, but those companies that are exposed to these longer term secular trends like AI, like internet commerce, like cloud computing, they have further to go. So that is definitely part of it. And I also agree, you were talking before about real estate. One of the best ways to add value this year has been to avoid what I would call rate beta. In other words, those segments of the market, whether we're talking about low-income consumers and companies that are geared to their spending, commercial real estate, smaller regional banks, these are all parts of the market that generally going to be more sensitive to the fact that rates have actually grinded higher this year. And one of the things we've done is try to minimize exposure to those segments. Generally, that's worked, and I think you continue to do it given this higher for longer environment.
There's an angst that's developing because people need something to worry about, people being myself, as everyone basically says the same thing in terms of crowding into the names that have been just throwing off bucket loads of cash and staying away from some of the more rate-sensitive sectors. It's the reason why we've seen the Russell 2000 underperform. At what point do you worry about crowding? And the sense that you can't avoid going into these stocks if you want to outperform, but that leaves the market that much more vulnerable to an idiosyncratic shock hinged to one of these companies.
I think this is a real risk, and it's very hard to argue that there's not been crowding, but it's been interesting. This is still a narrow market. It's still a market led by a handful of names, but you have seen some broadening out. Good example, utilities. Utilities is generally considered a low beta sector. It can be a very rate-sensitive sector, having a good year. Why is that? Well, of course, because for many investors, they're realizing that one of the constraints on the AI revolution is going to be electricity generation. And companies that are geared to that are geared to utilities, the grid, et cetera, many of them are having a great year. Now, this is something we didn't see 12 or 15 or 18 months ago, but I think it is an example of investors looking beyond 2, 3, 4, 5 companies and thinking about what are the other beneficiaries of this AI revolution.
Russ, I've got to ask, though, if that means the correlation between utilities and the biggest market weight on the S&P 500 goes up, what am I actually owning in the portfolio?
Well, you're still going to have a very big exposure to that mega trend. And that's going to be something, along with economic growth and rate beta, that you're really just going to have to decide how much of that exposure do you want. That said, again, I think the reason that these trades have become crowded is that there are multi-year trends, and the companies that are geared to them, and we know their names, are doing an amazing job of generating cash flow. And that's still a very desired commodity. And we think about what's working in this market, things like consistency, companies that can generate consistent revenue, consistent margins. And, again, if you can stay long those themes, I think you're going to do all right.
Saw this line from Mike Wilson at Morgan Stanley yesterday. He said, bottom line, the data remains mixed, leaving all the major macro outcomes on the table. Russ, it's never easy. I always sit here and say that. What you guys do is never easy. It's always easy looking back. But what about this moment is more difficult than maybe other moments in the past?
Well, look, I think I actually would agree with some of the premise of what Mike is saying, which is that it's complicated. Generally, the economy is strong, or it's certainly in decent shape. We had more evidence of that last Friday with the May non-farm payroll report. But there are segments of the market that are under pressure. We've spoken about the lower-end consumer. They are feeling the pain of higher rates. Commercial real estate, the smaller banks. So I do think that generally, if you look at the economy, you've got strong growth. It's likely to moderate in the back half of the year. But you have to keep thinking about what are the segments of the market that are going to feel pressure, because we are in a higher for longer environment where the Fed clearly does not have the latitude or the desire to rush and cut rates.
Hey, Russ, great to get your thoughts. As always, buddy. Russ Koesterich there of BlackRock. Tom Forte of Maxim Group writing this. Consumers feel like they have new phones when Apple updates its mobile operating system. To the extent it rolls out its AI-related efforts in a way that breaks that bond with consumers, that could result in backlash for the company. Tom joins us now for more. Tom, I just want to start with that point. In what way would that break its bond with consumers? What's your view on that?
There's two real risks to Apple's brand on Apple Intelligence. One is what I wrote there, which is when you buy an iPhone, you get that new iPhone feeling every fall when they roll out the new mobile operating system. So if Apple's saying, this Apple Intelligence is really cool, which remains to be seen if it is, but you need to have an iPhone 15 Pro because the chip on your iPhone 15 is not adequate to do it, then you do not get that new iPhone feeling every time they upgrade the software. And I think they're breaking a bond with the consumer. The other risk to brand is that they've named it Apple Intelligence. So if we use Siri as a guide, Siri's kind of been a failure to the extent that my own anecdotal use of Siri is a glorified egg timer. So to the extent that now I'm going to rely on Apple Intelligence and Siri for all this supposedly wonderful artificial intelligence, I think there's a lot of brand risk for Apple in the move here.
Tom, this is interesting because we caught up with Dan Ives, and I wish we'd formed a panel with you both a little bit early this morning. Dan Ives of Wedbush earlier today was saying this is it. This is going to be the thing that unlocks that elusive upgrading cycle, that mega upgrading cycle we've been looking for years now. Dan says it's just around the corner based on what they released yesterday. Why is he wrong?
He's wrong because I think that artificial intelligence is not ready for prime time. When you think about hallucinations, you think about the many issues that Google's had with Bard, and then now integrating with ChatGPT. Consumers are going to get a lot of bad information. It may not be have a rock every day or, include the glue when you make the pizza to keep the cheese to stick, things of that nature, and it may be. So I think that I understand why Dan thinks this could be the elusive upgrade cycle, the first major upgrade cycle since 5G, but I'm not convinced that we're there yet.
Tom, just to put a bow on this, basically we heard from Dan Ives that he will wear a black suit if they don't get the kind of increase in sales. Will you wear Dan Ives' wardrobe if they do see that increase in sales come September?
I will wear his most obnoxious, boldest colored outfit. We could go Knicks, blue and orange, even though I'm a Bulls fan. Absolutely.
All right, we will be there for that. I will wonder, just going forward, you said something that I found really compelling, that this is breaking a bond with the consumer. There has been a feeling that if you had an Apple phone, if you had an iPhone, you would be a subject of whatever kind of new advancements were coming out for the phone specifically. You think that this is actually going to cause people to turn away from the iPhone. Is that correct? Or else just keep their old ones?
I think there's real risk here that the consumer will be less enthralled to continue to buy smartphones from Apple if they don't get that new phone feeling every fall when they upgrade the software. So yeah, I think that's a real issue.
Where do they go? And I guess this is why we saw Samsung kind of trolling Apple yesterday, putting this out. Adding Apple doesn't make it new or groundbreaking. Welcome to AI, followed by an Apple emoji. This was Samsung's official account, putting that out there on social media. Do you think that Samsung wins out here if they introduce something that's more polished, more advanced, and frankly diverges more significantly from what's currently available?
Well, I think Samsung could win out to the extent that a consumer dissatisfied with the Apple experience, either because of Siri or Apple Intelligence or things of that nature, may gravitate to Samsung. So yes, but at the same time, I think that the AI issues are kind of industry-wide. There's hallucinating on Samsung phones as well. But yeah, I think you might see some switching here if this bond is in fact broken.
Tom, this relationship with Google is interesting. You're one of the few that's really, really digging deep and talking about it. I assume we'll be spending lots of time doing other things and less time on Google search. And I'm trying to work out if that's sort of good for Apple and bad for Google, or bad for both.
I do think that bad for Google is a fair interpretation of yesterday's news to the extent that they're integrating ChatGPT, although they did open it to other large language models, including Gemini from Google. But yeah, I think that the challenge for Google in search is to the extent that Microsoft integrates OpenAI's technology, and to the extent that consumers lean into artificial intelligence to advance search despite the challenges, that could be a real issue for Google.
Not just Google. There is an issue for a lot of apps and app creators that came out. I'm thinking of Grammarly. I'm thinking of some others. There was sort of a list of RIP, all of these different apps yesterday trending as people took a look at what would be rendered obsolete by some of this technology. Do you think there's going to be a real tension, particularly with Apple's dominance in the App Store, between some of these app providers and, frankly, the fact that they've been rendered obsolete overnight?
Absolutely. The number, though, that stood out to me yesterday is that there's only 2,000 native apps for the Vision Pro. So that feels like a low number 1 year into the product. And it reminded me on larger scale of the flashlight app. So there was a point in time where if you wanted to use your iPhone as a flashlight, you had to get a dedicated app. Now it's a feature within iPhone. So yeah, I think there's a lot of risk of irritating the developers here as well.
Tom, just finally, we'd love your view, just to finish up. I want to hear a little bit more from you on Elon Musk and that complaint from Elon. What did you actually make of that? Do you actually think he'll follow through with that?
I do. And so I admit, though, I'm only halfway through Isaacson's book on Elon, which I'm enjoying immensely. But I do think that Elon, while he may crave drama, I think there's a lot of validity into his comments. And I worry about the consumer who flip-flops between Apple Intelligence and ChatGPT, one that's supposedly privacy protected and then one that's open and doesn't know better. So I think there's going to be a lot of fun stories. The good news is now we have Apple strategy. Now we get to see how it works out.
Interesting. Tom, looking forward to the results. Tom Forte there of Maxim Group. Ives of Wedbush joins us now for more. So Dan, let's separate the two stories. The complaint coming from Elon Musk and what was unveiled yesterday, and you were in Cupertino, California. So Dan, tell me how impressed you were by yesterday's release.
I thought it was a historical moment for Apple, because this is really now, as much as we talk about the generative AI from an enterprise perspective, the consumer AI story is going to go through Apple. This was significant. I believe this will be a catalyst to an AI-driven supercycle over the next 2 years.
Dan, we started the program by talking about Apple always being late but better. Can you tell me if this is late and better? It feels late. I just need to understand if it's better.
Yeah, I think Lisa was exactly right. It's late, but you have 2.2 billion iOS devices. So they could be late, but they have an install base that's unrivaled. And that's really what they're going after right now. It's going to be on the services side, the monetization. I think eventually will be a subscription service. And then this is something, if you don't have an iPhone 15 or later, you're not going to be able to access Apple Intelligence. And I think that is the key. The headline here is the long-awaited upgrade cycle that we've talked about a lot on the show is now in front of us.
So let's dig into that a little bit, Dan. If we don't see a material uptick in sales, say in September, November, December, and October, are you going to basically retrench some of your bullishness, or do you think it could come as late as next year and it still would be valid?
Yeah, if that doesn't happen, I'll come into the studio wearing a black sports jacket because I believe this is the start of a renaissance of growth. And I think what's important now is that Apple, really unveiling their AI strategy. Of course, Altman there, the OpenAI being significant. I mean, this is ultimately most consumers, 25% in the world, they will access AI through an Apple device.
Well, if we end up with sales as soon as next week, you'll be wearing the drapes. Dan, I am curious about the idea of a subscription service. What are people going to be subscribing to, given the fact that right now you've got Apple Music, you have a number of other services. Are they going to subscribe to Apple Intelligence?
I think at first it's free, and that's the key for any Apple user. But this is essentially an AI brain in the iPhone. And where eventually this is going to go, developers that were all there yesterday that I saw, they're going to be building hundreds of apps based on this technology stack within the Apple ecosystem. And that's where more and more consumers are going to interact with it. This is just the start of now this AI party coming to Cupertino. But as much as it's late to the party, it's still 9 p.m. in this party that I believe goes to 4 or 5 a.m.
So, Dan, can you tell us why Elon Musk doesn't want to attend?
Because Musk, it's sour grapes. Because ultimately, this is what he wanted to do from a Tesla perspective. Obviously, there's a beef with OpenAI going back, years. But this is essentially Apple in their castle saying, it's our data, it's our customers, you're not going to have access. But I believe Musk, this could be just some stress going to shareholder meeting this week. He's not going to ban iPhones, in my opinion.
In super, super simple terms, can you explain what his complaint actually is? What's he concerned about?
He's basically concerned about Apple and OpenAI having access to the data and no one else has access to it. And that what he speaks to would be a broader concern among other tech players because Apple has a castle that no one else has. They have the devices. It's 1.5 billion iPhones worldwide, and they're saying it's mi casa, not su casa.
So, Dan, you mentioned Musk and Tesla and some of the issues he's having. That stock, that name falls under your coverage. You're clearly very, very constructive on Apple. Where are you now on Tesla?
Look, I think they've gone through a Category 5 storm, but they're starting to turn the corner. And in terms of what we see later this week, I think that comp package does pass. That does remove an overhang. And then it's all about stabilization in China, FSD and autonomous going forward. But I think right now the risk reward is there positive. That's why the stock, I believe, is hanging in even though they're going through some tough times from a demand perspective. Better days ahead, despite what's definitely a white knuckle period for Tesla shareholders.
That said, Dan, we talk about the AI supercycle, and that's the reason why Apple is sitting in its castle and creating a party that's going to go to 4 or 5 a.m. But there's a question for Tesla where you have Elon Musk. You said sour grapes about not having this first. This is what he wanted. He wanted the castle. And reportedly diverting chips from NVIDIA, from Tesla, to some of his other efforts because he has no place to deploy them. Does that concern you at all in terms of Tesla's valuation as a technology company and not as just a car company?
Yeah, look, the AI initiatives have to be under Tesla. And I think when Musk made that threat, and this will come out of the shareholder meeting as well this week, 25% ownership, otherwise he takes AI out of Tesla. It does raise some concerns, but I believe at the end of the day, it's all going to be under the hood of the Tesla ecosystem. And look, Musk right now, it's a balance. But this is it's a pivotal time for Musk to prove that AI will be under Tesla. He recommits to being CEO, I believe the next 3 to 5 years. And I think then we have better days ahead. But right now, it's definitely been another turbulent period, and he doesn't help that.
Dan, on a bigger level, this is the first day of a 2-day Fed meeting, and a lot of people are wondering, how long can this continue, where the AI early starters just basically accumulate all the cash and are the winners and accumulate all of the investments that we have from a lot of different investment managers, and they leave most people behind. How long can that divergence continue before something's got to give?
Look, I've been in the Valley now for 2 weeks. Seen 20 tech companies, all front and center in terms of the AI revolution. This is a 1995 moment, not a 1999 moment. And what I mean is the stronger and get stronger. And I don't see any slowdown, what we're seeing here, what we're seeing in terms of supply chain in Asia. And that's why I believe this is a tech bull market that continues to go forward for the next 18 months. But they'll be in the right lane, 45 miles an hour in the minivan, worrying about valuation. I just think right now this tech party is going to be left lane, 100 miles an hour. I don't see it slowing down.
Joining us now to discuss is TD's Mark McCormick alongside Santander's Stephen Stanley. Gents, great to catch up with you. Stephen, I've got to start with you. We caught up with you a few months ago. I believe you were sat right here to the right of me, not to the left of me. And I was speaking to this individual about when we were going to get that first interest rate cut. And you said something like November. And Lisa and I sort of looked at each other like, this guy, a little bit nuts, a bit crazy. Started 24, everyone's looking for March, and you're like, November. November, it's still November, isn't it?
That's still my call, yeah. Yeah, I think the inflation data are not cooperating, so it's still going to be a while.
How do you think they'll view the labour market data from Friday?
Yeah, I mean, I think Chairman Powell kind of broke the link a little bit between the labor market and the economy and inflation earlier this year when they suggested that maybe we can have the economy continue to grow and still get inflation down. I think that was a bit of an ill-fated shift on his part. But I think the labor market only comes into play, it feels like, if things start to weaken dramatically, and obviously may suggest that that's not happening. So it's back to inflation.
Matt McCormick, I want to turn to you. How important is tomorrow morning's payroll CPI print?
I think it's important, but I think, as you mentioned, the key thing here is like progress on inflation. I think that's part of the thing is it's a stumbling block. We're not seeing the progress that we need. You're also going to see the Fed likely revise up their core PCE numbers in terms of the target number they're looking at. So when you think about whether or not inflation is moving in the right direction, it is. Is it moving fast enough for the markets to kind of get on board with the certainty of how many times they can cut this year and reduce the volatility in the bond market? I don't think we're going to see that tomorrow. So I do think the key here is there's an intersection of volatility that's not priced in the markets, the geopolitics, which continues to push on the fiscal side, and the fact that the markets aren't really prepared for any of this.
So do you think, Mark, that the Fed's going to respond to this by doing absolutely nothing, trying to keep things as stable as possible and having an otherwise, just in terms of the balance, a bit more of the dovish side of things than hawk?
Yeah, I think they're going to try to sound neutral. They can't really project anything into September or November or December at the moment. They still need to see 4 inflation reports till we get to the September meeting. So I think right now the forward guidance, and I think markets understand this, there's not much significance that comes from forward guidance because we're all data dependent. So as we kind of watch the data come in, if it's a soft month over month, which is maybe a 0.26, or if it's a hot month over month, which is maybe 0.28. We're talking about decimal points, which, the Fed can't really provide the guidance for the markets to feel very clear about where we're going on this. And I think the one thing that, most people who are covering the market now feels much clearer about is we're just going to see more volatility. And I think that's the key thing that we need for markets is really you should be trading and thinking about the surprises. Everything needs to go right to get to this clear path, but you only need 1 or 2 things to go wrong. And that's where the asymmetries lie for markets, especially on the FX side.
All right, well, we'll get to the FX side in a second. But, Stephen, from your vantage point, this extreme volatility, is there a cost to that? when it comes to both economics, but also just market risk, when we talk about how rapidly some of these yields are swinging, even if they end the day at the same place?
Well, I think it makes it very difficult as an investor. And the Fed certainly doesn't like to cause volatility, so they're going to try to do what they can to give an accurate picture of where they're headed. But the problem is that they're data dependent. And so if the data are volatile, back and forth, high and low, then the markets are going to be volatile, and the expectations around the Fed are also going to be volatile.
Do you think they still believe that financial conditions are tight?
I think they believe that the level of the funds rate is very tight. Obviously,
what do you think that's based on? Because we heard from Bill Dudley, former New York Fed president, wrote a great piece on Bloomberg Opinion and said maybe it's high indefinitely, not high for longer.
Yeah, I think the problem for them is that there are tailwinds that are working against what they're doing with the rate level. One is their own balance sheet strategy, where the balance sheet is still too big, and that's a lot of excess liquidity sloshing around in the system, making financial conditions easier. And the other one is fiscal policy, which is continuing to stimulate the economy.
The stress that we are seeing, pockets of it, we're seeing it at small banks, regional lenders, saw that last year. Got PIMCO this morning warning of more to come. We're seeing certain buildings have some difficulty and get priced at really, really steep discounts, particularly here in Midtown Manhattan, another example of that. Where do you think that is on the radar for these officials?
Definitely watching it. I mean, I think to some degree, the Fed probably looks at the CRE situation and says, look, this is something we can't really address directly, because this is a secular change in the demand for commercial real estate after COVID, right? So there's only so much they can do. They can help to smooth the transition, but this is a change in the valuation of this sector that needs to happen. But I think what they're watching more broadly is, are we seeing the effects of high interest rates? And it does feel like we're starting to see that more. You're hearing it more in the housing sector. The ISM non-manufacturing report last week, there were several mentions by respondents in different industries who were saying high interest rates are really a negative for my business right now. So, I mean, I think from that perspective, they're probably justified in feeling that the policy rate itself is high, but as you say, financial conditions generally are not particularly restrictive.
Mark, to build on that, I remember a couple of months ago, people were looking at property markets around the world to determine which currency to go with. That was actually one of the big risks and potentially indicators of a central bank that would essentially be forced to cut in order to preserve the sanctity of the economy in that region. Do you think that that's still applicable?
Yeah, that's something we track very closely. We kind of look at the effective mortgage rates and how it's correlated with interest rates and kind of which currencies are most vulnerable to that. You could play the home base here, but it's very clear this is on the Bank of Canada's radar screen. And it's very clear this is something that was on most European currencies' radar screen. I always find the primary case study was Sweden, which was, if you looked at the mortgage rates, the bulk of the mortgages were under 1 year and they were floating. So Sweden already took the pain medicine. They've already had a massive move in the currency market. Things are starting to stabilize a little bit, but that is something that's on, I think, the radar screen, which are the next tiers of countries that are very vulnerable to a housing disruption. And again, this is something that's very insulated and something that's resilient for the U.S., at least relative to other currencies, and how you would look at the housing market as an impact. So I'd say the one that's on everyone's radar screen that we talk to happens to be Canada, largely, again, because they're mostly under the 4 to 5 year fixed, and those fixed mortgages are adjusting from the COVID period now, and you're basically seeing mortgages go from 1.5 to 2, all the way up to maybe 5-6%. So that is something that is going to feed into consumer spending, consumer slowdown, and this is part of the G10 central bank divergence story, which is, the Fed might not just have to go as quickly or might not be able to go at all, where all these other central banks do have to go, and they have to go now.
Stephen, housing is one thing. Commercial real estate, though, is another. And you are seeing, as John mentioned, $200 billion of maturities coming up within the next 24 to 18 months. And there's a question of whether we're accurately pricing the risk that this could cause the Fed to respond in a more material way. Should it be, I don't want to say contagious, that might be too strong, but have sort of trickle-out effects. Do you buy into any of this? Are you watching this to really understand that risk?
Well, I think one thing to keep in mind is that, and I mentioned the balance sheet before, I mean, liquidity is still plentiful, right? So this isn't likely to lead to a broader credit crunch. I think the other issue is, unlike the housing situation 15 years ago, there's not a ton of like leverage spread through the system that hinges on commercial real estate. So I think the risks are very different than they were in the lead up to the financial crisis. Having said that, I have to say, banks are sitting with a lot of loans on their books that are in some jeopardy. So I think there will be further adjustment going forward. It's just a matter of how broad that pain gets and what the overall environment. Is it resilient enough to manage through that? We're going to continue this conversation with Mark McCormick at TD. I know you've got to run, so I just wanted to get some details from you. November's when they're going to move. First cut, that's your call. Can we just go to the dot plot just quickly tomorrow? What's that look like, 2 or 1? I think it's probably, median is probably 2. There'll probably be a minority of people with 0 or 1, though. What do you think the forecasts directionally are going to look like? Are we revising growth up and inflation up, unemployment higher? What's that look like? Not much of a change in growth and unemployment, but probably we're going to need to go up on inflation just by what's already happened. Just a nudge higher on CPI. The difference between the Federal Reserve and the ECB, though, is that they do that and they're not cutting interest rates on the same day. Well, they weren't pre-committed, so... Can you imagine? Can I just finish on that? Can you imagine if the Fed did what the ECB did last week? What do you think that would look like in markets? Well, so the Fed historically has tended to have a very high bar for their first move. And the ECB, as you said, kind of locked in that first move early. The Fed has never really behaved that way. So it's hard to say, but yeah, that would have been interesting. I forgot who wrote the article, but it was someone here at Bloomberg that referenced a reverse Trichet. So Trichet, for those of you that maybe aren't familiar, former ECB president, did a couple of hikes at precisely the wrong time. I think one was in 2008, another series of them around 2011, around the Eurozone debt crisis. A reverse Trichet being ultimately, you've cut too soon, that the cut's the mistake this time and not the hike. Well, we'll see. I mean, is that really the reason why the euro is weakening so much? Probably some other issues. But it's a good question, and it's something that people are going to be asking. Yes, something we'll keep asking. Stephen, it's good to see you. Thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.